Have you ever wondered what it actually means to own a share of a company? When people say they own Apple, Coca-Cola, or Microsoft shares, they don't own the whole business. They own a tiny piece of it. Welcome to Valkyrie Investing. In this video, we'll explain exactly what shares are, why companies sell them, how investors make money, and the risks you need to understand before investing. By the end, you'll know one of the most important concepts in investing. Imagine your friend wants to open a coffee shop. The business needs $100,000 to get started. Instead of borrowing all the money from a bank, your friend decides to divide the business into 100,000 equal pieces called shares. Each share costs $1. Your friend then asks their friends to buy one or more of these shares. If you buy 1,000 shares, you now own 1% of the business. Owning shares means you're one of the company's owners. Although you may only own a tiny percentage, you share in the company's success. You don't take part in the management of the business. The owners choose a manager to run the business. You are an owner, also called an investor. If the company grows, the value of your investment will grow with it. If the company struggles, your investment can lose value. However, unlike a private business that you may run, if the company fails, the maximum you can lose is the money you paid to buy those shares. Companies sell shares to raise money, as we have seen in our previous example. That money can be used by the company to build new factories, open new stores, develop new products, hire employees, or expand into new countries. Selling shares allows companies to grow without taking on too much debt. Not every company sells shares to the public. Many businesses are privately owned. When a company decides to sell shares to the public for the first time, it's called an initial public offering, or IPO. After that, anyone can buy or sell those shares on a stock exchange. The stock market is simply a market where the product being sold is shares, otherwise known as stock, in companies. It is a place where buyers and sellers trade shares. Companies don't usually receive money every time shares are traded. Instead, investors buy and sell shares with each other. The seller of the shares is the one who receives the money. Like in any market, prices change every day depending on supply and demand. Share prices move because investors constantly change their opinions about a company's future. Good profits, new products, strong sales, or economic news all influence whether investors are willing to pay more or less for a share. There are two main ways investors make money from shares. The first is capital growth. If you buy shares for $10 and later sell them for $15, you've made a profit. That's the capital growth. The second is through the company paying what's called dividends. Some companies share part of their profits with shareholders, the name for the investors that own shares in the company, through regular cash payments. These may be annual, semi-annual, or quarterly, and will be announced as dollars or cents per share. Not every company pays dividends. Fast-growing companies often keep their profits to invest back in the business. More mature companies may regularly pay dividends to reward shareholders. Both approaches can create wealth over time. Shares don't always go up. Companies can lose money. Economic conditions can change. Competition can increase. Some businesses even fail completely. That's why investing involves risk. Professional investors rarely put all their money into one company. Instead, they spread their investments across many different businesses and industries. This is called diversification. This can be done by buying a mutual fund or an exchange-traded fund, something I will talk about more in a future video. It can also be done by owning a portfolio of shares. That's a collection of different shares in different companies and maybe different industries or even different countries. It helps reduce risk if one investment performs badly. When you buy shares, you're investing in real businesses that produce real products and services. Every day, millions of people use products made by companies whose shares are traded on stock markets around the world. Companies like Coca-Cola, Amazon, Apple, Enron, Samsung, there are thousands of them. Successful investing usually isn't about buying and selling every day. Many of the world's most successful investors focus on owning quality businesses for many, many years. They allow time, growth, and compounding to work in their favor. Now, most beginners make avoidable mistakes. Buying because everyone else is buying. Panic selling during market falls, trying to get rich quickly, or putting all their money into one stock. Successful investing is usually more about patience than about excitement. So let's recap. A share represents ownership in a company. Companies sell shares to raise money. Investors can make money through rising share prices and through dividends. But shares also carry risk. That's why diversification and long-term thinking are so important. Understanding shares is the foundation of successful investing. Once you understand ownership, the rest of investing starts to make much more sense. If you found this video helpful, please like, subscribe, and join us on your investing journey. Remember, understanding before investing.